$50,000. It doesn't sound like the beginning of a fortune, but in Australia right now, that amount sitting in your bank account is a decision, and the decision you make with it could be the single biggest financial turning point of your life. So here's the question that has divided dinner tables, online forums, and financial advisor offices across the country. Do you put that $50,000 into the Australian share market, or do you use it to get a foothold in Australian property? Both paths promise wealth. Both paths carry risk. And the answer is not as obvious as most people think. Australia is one of the only places on Earth where this comparison gets genuinely complicated because Australia has features that change the maths entirely. Franking credits, negative gearing, leverage on a heavily regulated lending market, the ASX's dividend culture, and a housing market that has been the envy and the frustration of the developed world for 3 decades. So let's pull this apart, number by number, risk by risk, and find out what actually wins when $50,000 goes head-to-head. First, let's be completely clear about what this comparison actually is. This is not a lifestyle discussion. This is not about whether renters are morally superior to homeowners. This is a pure wealth-building conversation. $50,000, 2 paths, and a long time horizon. What does each path look like when you follow the data honestly? Let's start with the share market case, because in Australia, it is a stronger argument than most people give it credit. The S&P/ASX 200 has compounded at more than 9% per annum over the last 10 years when dividends are included. When you factor in the power of Australia's franking credit system, a feature that is genuinely unique to this country, that total return rises to an average compounding rate of around 10.6% per year. Think about what that means for $50,000. At 9% compounding annually over 10 years, that $50,000 becomes approximately $118,000. Over 20 years, it grows to roughly $280,000, all without borrowing a cent, all without a single phone call to a property manager, all without a leaking roof, a difficult tenant, or a legal dispute at VCAT. And here's the part that often gets overlooked. The franking credit advantage is a specifically Australian wealth-building tool. When Australian companies pay dividends, they attach a franking credit representing the corporate tax already paid. For Australian resident investors, particularly those in lower or middle tax brackets, these credits can be refunded in cash by the ATO. That means the income from an ASX dividend fund is genuinely worth more, sometimes significantly more, than the headline yield suggests. Franking credits have historically added around 2% per year to ASX 200 total returns. That is not trivial. Over 2 decades, that 2% difference compounds into tens of thousands of additional dollars. Now add dollar-cost averaging to the picture. If that initial $50,000 is just the starting point, and the investor adds even $500 per month into a broad ASX index fund, the trajectory changes dramatically. Compounding at 9% annually, consistent monthly contributions of $500 on top of a $50,000 base would grow to well over $600,000 over 20 years. That is the power of time, consistency, and not panicking during market corrections. The entry costs for shares are essentially zero. No stamp duty, no conveyancing fees, no building and pest inspection, no lender's mortgage insurance. The full $50,000 is deployed on day one. And if life changes, a job loss, a health event, or a better opportunity, the shares can be sold in seconds. That liquidity is not just a convenience, it is a genuine financial safety net. But here's where the property argument gets genuinely compelling, and it comes down to one word: leverage. When a property buyer uses $50,000 as a deposit, they are not just buying a $50,000 asset, They are potentially controlling a property worth $250,000 or even $300,000. That is a 5-to-1 leverage ratio, and it changes every calculation that follows. Australian residential property has averaged around 6 to 7% annual capital growth over long periods across the combined capital cities. But here is the critical distinction. That 6 to 7% growth is not on your $50,000. It is on the full value of the asset. On a $250,000 property growing at 7% per year, the dollar gain in year one is approximately $17,500. On a $50,000 share portfolio growing at 9%, the dollar gain in year one is approximately $4,500. Even with a lower percentage return, the property investor is capturing gains on a far larger base. Over 10 years, a leveraged property acquisition, even a modest one, can produce extraordinary cash-on-cash returns when the numbers are worked through honestly. This is the reason property created so much wealth in Australia, not because it is a better asset in isolation, but because the banking system allows everyday Australians to control a large asset with a relatively small capital outlay. Then there's rental income. A well-located property can produce a gross rental yield of between 3 and 5% depending on the city and property type. In Brisbane and Adelaide, current gross yields for houses can sit about 4%. While this income is taxed, it partially or fully offsets the holding costs of the investment, mortgage interest, council rates, property management fees, and maintenance. And then there was negative gearing, a strategy where the losses from an investment property could be deducted against your personal income, reducing your tax bill. For high-income earners, this created a legitimate after-tax subsidy on holding a property that generated losses before capital growth was factored in. For decades, negative gearing was one of the most powerful tax tools available to Australian investors. But here is where everything is changed, and this is a critical update for anyone assessing the property versus shares debate in mid-2026. On 12 May 2026, Federal Treasurer Jim Chalmers delivered a budget that fundamentally rewired the tax treatment of Australian property investment. Negative gearing on established residential properties acquired after that date has been restricted. Losses from established investment properties can no longer be deducted against wage or salary income. They can only be offset against rental income or future capital gains from property. Additionally, the 50% capital gains tax discount, which has existed since the year 2000 under the Howard government, will be replaced from 1 July 2027 by an inflation-based indexation system with a minimum 30% tax on capital gains. These are not rumors. These are not proposals. These are legislated changes that are now in effect or coming into effect very shortly. The combined impact on established property values has been assessed by economists using modified RBA modeling, and the consensus figure is that house prices will be approximately 3% lower than they otherwise would have been as a direct result of these reforms. For anyone using negative gearing as a core pillar of their property investment thesis, the landscape has genuinely shifted beneath them. Now, let's talk about the costs that are quietly devastating the property case when you only have $50,000. The entry costs for property are brutal. Stamp duty varies by state and buyer type, but on a purchase of $250,000 for a non-first home buyer investor, stamp duty in New South Wales alone would typically be in the range of $7,000 to $8,000. Legal and conveyancing fees add another $2,000. Building and pest inspections another $500 to $800. And then the real killer for a small deposit, lender's mortgage insurance. When a buyer puts down less than a 20% deposit, most lenders require LMI. On a $250,000 property with a $50,000 deposit, which is a 20% deposit at that specific price point, LMI would technically not apply. But in most Australian capital cities in 2026, $50,000 as a deposit represents far less than 20% of any realistic purchase price. In Sydney, where median house prices remain above $1 million, $50,000 represents less than 5%. In Melbourne, Brisbane, and Adelaide, it is still only 5 to 10% of a median-priced property. That means LMI is almost certainly unavoidable. And LMI on a purchase with a 5 to 10% deposit can add tens of thousands of dollars to the cost of entry. That cost does not go towards your equity. It is a pure sunk expense. So the $50,000 that looked like a deposit, after stamp duty, legal costs, inspections, and LMI, may genuinely only represent $15,000 to $20,000 of actual working capital in the property. The rest has been consumed before the first tenant has moved in. The share investor? Every single dollar of that $50,000 is working from day one. Now let's look at the environment these two investments face in June 2026. The Reserve Bank of Australia's cash rate is currently sitting at 4.35%, having been lifted again at the May 2026 meeting. The RBA has now hiked 3 times in 2026 alone, with trimmed mean inflation currently running at 4.2%, still significantly above the RBA's 2 to 3% target band. Some major bank economists are forecasting at least one more hike before year-end, with NAB flagging August and Westpac projecting a potential peak as high as 4.85%. What does this mean for property? Higher rates mean higher mortgage repayments. For a variable rate home loan in June 2026, owner-occupiers are facing mortgage rates broadly in the 6 to 7% range, depending on their lender and loan structure. For property investors, those rates are typically even higher. The carrying cost of a leveraged property in this rate environment is significant, and for negatively geared properties, the restrictions introduced in the May 2026 budget mean that those losses no longer flow through to reduce your income tax bill. For shares, a high interest rate environment is not without challenges either. Higher rates typically put downward pressure on equity valuations, particularly for growth stocks. But an ASX 200 index fund, dominated by banks, miners, and high-yielding consumer staples, is generally more resilient in a higher rate environment than growth-heavy indices. In fact, Australian banks, which represent a large chunk of the ASX 200, tend to see improved net interest margins when rates rise. This is not the case in every high-rate environment, but it provides some counterbalancing support for dividend-focused ASX investors. There's also a psychological dimension to this comparison that deserves honest examination, because behavior is as important as math in wealth creation. Property has a well-documented behavioral advantage. It forces discipline. An investor who buys a property cannot panic sell at 2 in the morning when the news cycle turns negative. There's no app to check overnight, no real-time price feed making a bad week look catastrophic. The emotional friction of selling a property, agents, settlement timelines, legal processes, acts as an involuntary circuit breaker against poor decision-making. Shares, on the other hand, can be sold in seconds, and research consistently shows that individual investors destroy value by selling at the wrong time. The average retail investor significantly underperforms the index they invest in, not because the index is a bad investment, but because behavior degrades returns. Fear sells at the bottom, excitement buys at the top. If an investor cannot maintain discipline through a 30% market correction, the theoretical compounding advantage of the share market may never be realized. The best investment is always the one you will actually hold. But here is the honest conclusion that the data demands, and it may surprise those expecting a clean winner. At a $50,000 starting point in June 2026, shares are arguably the stronger pure investment. Here's why. The entry cost advantage is decisive. Every dollar goes to work immediately. The compounding returns of 9 to 10.6% annually are well documented and not subject to the tax changes that have now fundamentally altered the property investment landscape.
Liquidity provides a safety net that property simply cannot match. And in an environment where the RBA is still raising rates, where negative gearing has been restricted, and where the CGT discount is being abolished for future gains, the risk profile of leveraged property has genuinely increased. That is not to say property is a bad investment. The leverage argument remains powerful for those who can afford it properly. A well-resourced investor who can put down a genuine 20% deposit, avoiding LMI entirely, buying a property in a fundamentally strong location with solid rental demand, is still building wealth through the most powerful mechanism available to everyday Australians: borrowed money growing a real asset. Historically, property has delivered extraordinary outcomes for Australians who held for the long term and avoided forced selling. The answer for most people building wealth in Australia in 2026 is actually both. Start with shares, build the base, capture the compounding, understand the market cycle, and accumulate without the burden of debt or entry costs. Then scale into property once the deposit base is strong enough to buy genuinely well, without LMI eating your capital, without insufficient cash reserves leaving you exposed to a rate spike, and without relying on a tax strategy that has now been materially eroded. $50,000 is not the destination, it is the launch pad. And right now, the most logical launch pad points directly toward the simplicity, compounding power, and cost efficiency of the ASX. Use it well, be patient with it, and let the maths do what the maths has always done for disciplined Australian investors. The share market versus property debate is not won by one side. It is won by the investor who understands both and makes the right move at the right time with the right capital base.